your conference to begin.
Rolling in. Okay. All right.
Hey, good evening, everybody. It's February 27th, almost the end of February. And we're here again tonight with another lesson regarding money that will help you with tax-free income for dentists. Quite a few things that we've been teaching over the last 5-6 months. They're all listed on our website, taxfreeincomefordentists.com. Our books are listed there. But we really enjoy sharing some of these great details with you to help you run your practice better. My name is Stephen LeBroy. I'm the author of Build Your Human Equity Line of Credit, a financial strategist. And I want to introduce you once again, Rich Clouse, CLU, Chartered Financial Consultant. And Rich is the author of Rich Dentist, Poor Dentist, the book that really talks about building assets and operating a strong practice with the money that you make with revenues. Hey, Rich, how you doing tonight? Let's get it going.
Hey, Steve. Good. Hey, thanks for the nice introduction. Again, thanks for all of you for joining us tonight. And we're going to talk a little bit different tonight. I want to talk basically let me get my little tools working here. There we go. A little money lesson tonight. One of the things that we run into a lot is people say, when I first have some money, it could be a student with their first contract, it could be a dentist that finally paid off some bills, and they're trying to figure out, where should I be putting money? And one of the things that we want to talk about is, what type of risk do you take when you put money in various financial products? The first one that no one really thinks about is the risk of time. Depending upon where you put items in financial products, there are time requirements. A perfect example is a CD. If you buy a 2-year CD, that money's locked up for 2 years, and if you want to get the money out, you're going to be hit with some penalties to get your money back out. What are some other type of risks? One of the other risk is taxes. Depending on where you put it, if you want access to the money, you might have to pay income taxes to get it out. The other thing that's really important that a lot of people never think about is the difference between saving and investing. A lot of people think that's the exact same thing. You'd be amazed the number of dentists that Steve and I talk to that they say, I'm saving money in mutual funds. I'm saving money in stock. And we try to help them understand that there's a total difference in that. When you're putting money into financial products like mutual funds, you have risk. When you're saving money, you put it into vehicles that you don't have any risk. You might not get as high a rate of return, but you can't lose any money either. So that risk element really comes in and can kind of cause some problems. If you're familiar with the books or been on any of our lessons here from education, one of the things that we want all of our dentists to have is the item of luck on your side, LUC. The L stands for liquidity, meaning that you have access to the money that you've put away. The U stands for use, that you can use it for anything you want to use it for. And the C stands for control, meaning that you're the one in control to be able to make the decisions of how you want to deploy that money or redeploy it into other areas. So risk is important, but risk isn't just the amount of volatility you might have where it is. There's other things that produce risk that keep you from being able to use your money. If we go to number 2, we get asked all the time about putting money into investments, but in IRAs, 401ks, simple plans, Roth IRAs. And one of the questions that we always ask is, what access do you have? Now, some people know, but a majority of people don't really know what access they have. The key time frame when you put money into any of those type investments called qualified money is age 59 and a half. And what's qualified money mean? Qualified money is just any vehicles that are sponsored by the federal government that allow you to put money away on a pre-tax. In essence, our word is you're postponing the tax to sometime in the future. Well, you can't take money out before 59.5, or you get hit with ordinary income plus a 10% penalty. So going back to our risk, that's some risk if you put it into those. So the qualified money doesn't meet our luck because you don't have control. You can't use it. It's just sitting there, and it's not basically liquid for you to be able to get to. Another place that you can put money is I'm going to just abbreviate it, is non-qualified accounts. All a non-qualified account would be is something that is not sanctioned by the federal government in the form of IRA 401ks where the government has all the controls. A non-qualified account would be you just putting after-tax dollars into a mutual fund or into stocks or into real estate. Now, you still have some access concerns. For example, if it's a mutual fund, hey, you can sell it at the end of the day and you can have your money in a couple of days. If you put money, non-qualified money into real estate, well, there's some risk with that because you might not have access to it. Because as you know, to get money out of real estate, no matter whether you've got a paid-for piece of property or a leveraged piece of property, you either have to get a new loan or you have to sell the property. And both of those things, or neither of those things, happen very quickly. So non-qualified versus qualified. One ties things up for a long period of time, others you have access to. Now, number 3, what's the tax treatment when the money comes out of various products? We'll talk a little bit more in depth here in a minute about that. But if you use non-qualified money, and let's say it's mutual funds or it's stocks. Well, mutual funds every year will pay dividends and capital gains. Not guaranteed, but most every year they do. So in January, you may have gotten some a month or so ago. You get a 1099 from that mutual fund that you have to pay tax on any dividends or capital gains that mutual fund paid over time. With stocks, you may own stocks that pay dividends. If you own a stock that pays a dividend, you're going to get a 1099 to have to pay income tax on those dividends. The primary difference between mutual funds and stocks is you control the tax liability on stocks much more than mutual funds. And the reason being is in the mutual fund world, the manager of the mutual fund is buying and selling all year long. So you may not see it, but he sold a stock, made some profit. So even though you never sell anything in your mutual fund during the year, you could have taxable gains from the sale that the mutual fund manager has done. If you own stocks, it's all up to you and your advisor of whether you sell anything. If you don't sell anything, you're not paying tax on any growth of that stock until you decide to sell it. Now, you may again pay tax on dividends, but you're not going to pay tax on anything else. So what we want to do tonight is really talk a little bit about all of those things in a little more detail as we kind of move forward here. This is a new page that I don't think any of you have seen. Steve and I have talked about it, and we think it's important for dentists as they look through what are the risks on the dollars. You'll see here we've got dollars and we've got percentages. There's no finite number of what you should do. But what you need to understand when we're talking about risk is where and how does risk come in as you allocate dollars to different spots. So let's go all the way over to the left. The left is anything you put into this sector, if you will, has full market participation. In 2017, 2016, full market participation was great because the market was heading in the right direction. Full market participation in 2018, particularly starting in about February, was not too good at all. And particularly the fourth quarter, people got handed their lunch. A lot of them were down 10, 15%. So what constitutes something that's subject to full market participation? Well, mutual funds, because if they go up, you gained a lot of money. Separate managed accounts are kind of a weird term, but that's just where you put money and there's a manager that is moving that around a number of different styles and a number of different, whether it be bonds, stocks, U.S., non-U.S. So it's basically a stock managed account that you don't have much control over the taxation of it. Individual stocks, we just kind of talked about. You could have an asset allocation portfolio where you handle it or your advisor handles it for you, but the dollars are being moved back and forth between bonds, United States, worldwide bonds, et cetera. Same with stocks, big companies, little companies. So those have full market risk or participation. And again, as we've talked through the years, Steve and I have a lot of clients, times we'll talk about, great, I got full market participation. Other ones said, my gosh, that risk wasn't worth it. I had too much. A lot of people will own variable annuities. An annuity is just a wrapper that holds an underlying investment. Well, a variable annuity, the underlying investments are mutual funds. So those mutual funds are going to fully participate in the upside, and they're going to fully participate in the downside if the market goes down. Nothing wrong with any of these things we're going to talk about tonight. It's just you having the knowledge of where is your comfort level. A type of life insurance that falls into this category is variable life insurance. All the permanent life insurance policies have cash values. A variable life policy's cash values are tied to mutual fund performance. So it can look really good, but then if the market goes the other way, you could be on that downside of 10, 15, 20%. So it is subject to full market participation. Now, if we go and change to our next spot over here, market participation with guarantees. What does that mean? That means you're going to get some of the market participation from an upside potential, but you have some guarantees protecting you. So if the market went up 20, if you're in this middle column, you're not going to get 20, you might get 12, you might get 15. There's variations in how that would work. But some of the products that fit into that are fixed indexed annuities. What happens with that is your money is tied with indexed options. Now, I don't want to get too technical, but basically what that says is you have an opportunity to participate if that index option, let's call it the S&P 500, if it goes up over a 12-month period, and let's say it goes up 10%, you might get credited interest of 10% on your money that you have there. If it goes down 10%, your worst year of performance is a 0% rate of return. And the reason being because in an index scenario, index option scenario, you didn't own the individual S&P 500 stocks, so when it went down, you didn't lose any money. So you participate on the upside, but you have guarantees protecting on the downside. Very, very good products. We see people as they get older wanting to do those to protect that downside from losing. Now, variable annuities, just like we talked about on the other side, they still have the mutual fund base on it of where the money is invested in, but they come with some guarantees. That means you're not going to get the full upside potential, of it, but you're going to have the ability to have a guarantee of dollars growing and then a guarantee of receiving income for the rest of your life on a guaranteed basis. A type of life insurance that fits here is just like we talked about the indexed annuity. It's fixed universal life, indexed universal life. So your cash values are based on those index performances. Again, worst case year is a 0% rate of return. The other on the index performance, you can get up to as high, and they change all the time, so don't hold me to the number, but maybe 13.5% of the upside potential. In other times, it could be 5% or 7%. But you have that guarantee that you can't lose any money. When we get over to the fixed side over here, there are a lot of things that you've heard of. Okay, certificates of deposits. Everything really on this side is probably going to be relatively low interest in today's world because interest rates aren't very high. But as you can see, CDs, savings accounts, money market accounts, fixed annuities, a lot of people aren't familiar with this. Think of that as a CD from an insurance company. Any growth you get on that is tax deferred until you take money out. A lot of people like that because they don't want to pay any more taxes than they have to pay. So government bonds, corporate bonds. The life insurance piece that falls in here that primarily people will use is whole life coverage. The reason whole life fits there is because guaranteed premium, guaranteed death benefit, guaranteed cash values. That's the vehicle we use, a specially designed one, to set up the cap plans for all of our dentists when we're going to accumulate the cash value and help you loan it to your practice for practice equipment purchases, acquisition of practice, real estate for the practice, or anything else. Very predictable and repeatable dollars that are going to be there. Current assumption universal life, all that is your cash values are based pretty much like on a money market account. Back in the 80s, they were paying 10 to 12% when interest rates were really high. Today, they're probably in the 3 or 4% range. A lot of volatility in that with interest rates. It's not one of our favorite ones because there's a lot of movements in that. So think in terms of, from a psychological standpoint, you need to kind of figure out where do you want to be. Do you want a third, a third, a third in each one of these? Do you think, no, I'm young, I want 50% in the market, full market participation, a little bit in guarantees, and not much in the other? So part of the lesson tonight is hopefully just get you to think about some things. Okay, some of you have seen our pot here, if you will, and let me just change colors again. Let's see which color. Maybe I'll say this here. The yellow one is, as we've talked, qualified plans, IRAs, 401ks, all dollars that you have not paid tax on and will pay tax on when you go to withdrawal. Steve and I, day after day, when we see clients, when we ask them a question of the money that they have accumulated, how much of those dollars that they're going to use for retirement income, of all the money they have accumulated for retirement, how much is sitting in that yellow bucket? Surprises a lot of people. But what the answer we get is somewhere between 80 and 90%. Well, what they're doing there is they're playing a risk reward with the federal government on what direction do they think income taxes are going. We're going to look here at the history of tax again. I know a lot of you have seen it, but I want to put it together in the context that we're talking about today. The blue bucket in the middle is you put money that you've already paid tax on, and you're putting in places to where hopefully you can get long-term capital gain taxes. So to have less tax on money, which helps it compound and grow more down the line. Mutual funds would fall into this. Stocks would fall into this. Real estate could fall into that. A practice could fall into that. I'm going to run out of room here. Sorry. So your practice, you don't pay any tax on the growth of the practice until you sell it, and when you do sell it, you're going to get some capital gains treatment. When you come over to our far spot over here, this is designed to be tax-free. There's really only three things you can do. Roth IRAs, which are great, but you don't have luck on your side there because all the gains are tied up until you're 59.5. So they look good, but you can't use them for anything. Municipal bonds really don't come into play today. The reason they're sitting there is the interest that they earn and produce is tax-free, many times on a federal basis, sometimes on a state and a local basis, so they could be triple tax-free. But today the interest rates are so low, they're not a player. Now the life insurance properly done, the way we build our cap plans for our dentists, basically it works very much like a Roth. After tax dollars go in, it accumulates with no taxes on it. The difference between a Roth and a properly done cap plan is you've got complete access to the cash values to use, loan to the practice, et cetera. You put it back in, grows tax-free, and then you have tax-free access to produce retirement income that's tax-free. So very similar to Roth, but gives you access. And the longer Steve and I have been around, more access to cash and understanding cash flow are really every bit, if not more important than sometimes what the rate of return is going to be. So the wheres and the whats and the whens are really important here. Okay, here again is our U.S. history of tax. I'm not going to spend a lot of time with it, but it's important to understand when we first had taxes. I probably should come over here and let me see if I can find, I'm not sure if I can find. Well, it's a little red. The top tax bracket was 7% when, in 1913, the first time we had personal income taxes. And we always ask people, how happy would you be if the maximum tax rate was 7% these years? I think we all love it. Well, why have taxes gone up? Up to 73% the late teens. They had to pay for World War I. And as most of you know, that didn't mean you paid 73 cents on every dollar. There is a threshold amount that if you earned more income in a year than that threshold, on the next dollar you paid 73 cents. Well, World War I was over, got back down to 25%. Well, when in the Depression, FDR gets elected, starts social programs, work programs, Social Security, bridge programs, trying to get the public back to work and getting them some income. They had to pay for it. Rates went from 25% up to 63%. Then World War II started, went up to 78%. Didn't get enough there. They needed to increase it. So the max we've ever had was right at the end of the war, 94% tax. I'm not going to go into a lot of detail, but you may remember the example I give. There was an actor that got paid $100,000 per movie. And I always ask, how many movies did he do a year? Well, since the threshold was $200,000, anything over $200,000, he'd lost 94 cents to taxes. He did 2 movies a year. Makes all the sense in the world when you think about it. So World War II is over, 94 drops. The 91% is Korea, which it's interesting as we're talking again tonight. President Trump is meeting with the North Korean president trying to get some deals done. So it's really ironic that the Korean War was on here. The blip right there up is the Vietnam War. Here, when President Reagan took office, we had a marginal bracket of 70%. He wanted to bring them down. He got all the way down to 28%. Interestingly, and most of you know from reading the book, President Reagan was the same actor that only did 2 movies because he didn't want to have to pay that 94 cents. And he knew that if that had been lower, he would have done more movies, had a bigger farm, employed more people, things would have been better, which is exactly what happened in the 80s when he reduced marginal brackets. The 40% is the Clinton years, the Bush Jr. years, and the last here are President Obama's increases. The important point that Steve and I always want to try to get across with this is we're not against any of these things, and we're not categorically saying taxes have to go up. But if you look at demographics today, they've gone up for a couple different reasons, wars and social programs. Well, what haven't we seen in the last 5 to 10 years? We've not seen any increases for Afghanistan or Iraq, the cost. We clearly haven't seen any rate increases yet for the baby boomers and Social Security, Medicare, Medicaid, plus our $22 trillion debt out there. Our feeling is tax rates have to go up. They've been up, and they're going to have to go up to cover all of those things. So does postponing a lot of tax by stuffing it in 401ks, IRAs, and things like that, is that the only strategy you should be employing? We don't think so. That's why we think a mix of between these 3 buckets make all the sense in the world, because Steve and I wish we knew. We don't know what taxes are going to be down the line, but we want you to be in a position where you can have some options and choices. Okay, here's one that some of you may be seen and some have not. It's really important. Most people don't even realize that there are different types of assets out there. So what we want to talk about is first an OR asset. What the heck is an OR asset? Let's just say you had, because it's easy for me to write, $100,000. And you had it sitting over here in mutual funds. And you decided you didn't want it in mutual funds, you wanted to own real estate over here. Well, let me ask you a question. Could you have $100,000 in both mutual funds and real estate if you only had $100,000? Absolutely not. You can't. So when you have an OR asset, you can't have the same money in both places. So the OR asset limits what you can do. Now, you can put $50,000 in mutual funds and put $50,000 in real estate. The point being is you still only have $100,000 working for you. What's the AND asset? Well, it's the same thing. If you had $100,000 down here and we had it over here in your cash values, you've got the ability to leverage it, again, borrow against the cash values. I can't stress that enough. Steve and I do that every darn day to help people understand. You never take your cash values out of the policy. You borrow against them. You leverage those to do something else. Your cash values are still earning the same interest and the same dividend as if you'd have never leveraged them out. So over here, if that green doesn't look too good there, but if you used it for real estate over here, you now have $100,000 working for you in real estate. Your cash value is going to grow in your policy. Again, same interest rate, same dividend as if you'd never taken it out. So with your AND asset, you've got the same money working in 2 or more places. How many times would you want to do that? Opposed to one person having $100,000 working one place. Through time, and we'll talk about it here in a minute, most people have made significant amounts of money when they used OPM, which is other people's money. And what we want to do is bring that to the dentist where they can utilize it inside their practices and be able to take advantage of that. Things to always remember tonight. This is kind of the last page we're going to go through. You want and need to be in control of your money. Now, what does that mean? It is cash and cash flow. Because if you don't, you're not fully maximizing the amount of money that you can generate. The very successful financially and wealthy people have always used other people's money. In other words, you need to leverage your money to create more wealth. Now, what's another way you could use other people's money? It's not too good a writing there. Let me try that again over here. You can use the bank's money, and that's what many of you dentists on the call tonight have done. You've borrowed money to buy a practice. You've borrowed money from the banks to get equipment. So you're leveraging. The only difference is you're paying the bank to use their money, but you've leveraged it to create more wealth for yourself. But it's not as good as leveraging it when you can utilize money that you still control. So one of the things you really need to be careful, if you're not careful in where you put your money, kind of the whole tenet of tonight's talk is you can lose both number one and number two. You can lose the control of your money. You also can lose the ability to leverage it and create more wealth, for yourself. So as a result, it's just very important to understand you've got to be very careful where you put your money to make sure you can take advantage of both number one and number two. That doesn't mean you shouldn't ever put money in a 401k, IRA. We're sure not saying that. Our clients have a lot of money in those. But it's probably not the first thing you ought to do. You need to get that strong foundation of access to money and cash flow. So if you hit that either a good bump in the road where you've got some opportunities or a bad bump in the road where you need some money, you've got options and choices. Because whether you're just kind of getting... Yeah, Steve, go ahead.
I'm going to throw in, what I call that is by money pyramid in my book. It puts you in a position where your foundation is strong, and as you go up the triangle or pyramid, you can put a little money at risk, but you never know what events may come your way, known or unknown. So I appreciate that, bringing that out.
Yeah, that's right. So whether you're just getting started or you're making midstream changes, so if we start working with a dentist in their 40s, we're going to help them make midstream changes. And after you've been in practice a few years, you need to do some of those things. So it's really never too late to put yourself in control of your money. So this page is probably as important as anything. You want that money to grow as much as you can. I didn't talk about back here on the first page, right there. There's your house of money. We don't want the money flying away like that shows, out the window because of risk. We want you to be able to control it and grow it and have luck on your side. So when we get here towards the end, this is critical. People never think about it. You owe it to who? You owe it to yourself, you owe it to your family, and you owe it to your practice to make sure that you're doing the best job you possibly can. The banks are going to do just fine, but we don't need them to win more money and win at the expense of you and your wealth. If you don't think about it, don't understand it, don't talk with folks like Steve and I to help you understand where that money could go, you're going to be relegated to not having the wealth you really could have. So we want you to win the banking game, not the financial institutions. It's important. We don't have phone numbers for a lot of you. And you're entitled to a free 30-minute personal meeting with Steve and I to see how these strategies can help you work. But you need to take ownership. You need to take the time to pick up the phone and call, shoot Steve or I an email. You can see phone numbers down there, email addresses down there. Just let us know. We'd be happy to help you understand this more fully and how it can, really work for you. There are other website down there, the dentaldebtrelief.com, will get you to the same spot. There's all kinds of the tax-free pieces Steve was talking about, also a lot of blogs, podcasts that I've done. So anyway, we're starting to run out of time. I think Steve said there's a few questions that have come in. So Steve, why don't you let me know what those are and see if I can answer some.
All right. Well, appreciate you, Rich. And that was a great presentation. The last comment I'll make is we call it in our book being positively selfish. That means making sure that you're the most important piece in this puzzle and not the banks. So, yes, we do have a couple questions. We'll shoot you the first one. Must be from, okay, how do student loans or practice loans come into play with investments?
That's a great question. And it's probably one of the most difficult things for young dentists when they get out to kind of wade through. Because when they first get out, the advisors that are calling on them, the way the advisor is going to make money is if you give them your money to invest in things, whether it be mutual funds, stocks, 401ks, IRAs, and things like that. Our belief is you need to look very closely. We're not saying you shouldn't do that. We need to make sure we understand how those student loans are going to work. How do you have those set up? How quickly can you get them paid off? How quickly do you want to have them paid off? So the knee-jerk reaction maybe shouldn't be let's go investments. Maybe it's let's go savings and control that money and get out of debt before we have a lot of money at risk in the investment spot. Got another one there, Steve?
Yep. Next one. If I can put money into a 401k, an IRA, even a Roth, or et cetera, should I do it if I have existing loans? So putting money into other qualified investments, even if I have existing loans, should I do that?
Well, and again, it's about, our belief is macro planning, not micro planning. The micro plan is you look at the IRA, you look at 401k, and the advisor's talking to you and you go, yeah, I want to do that. Well, macro planning is how do you evaluate not only the student loans, but the access to money to be able to get to, whether it be to pay student loans off, which once you get it, as you are aware of after tonight, once you get it in the 401ks or the IRAs, you don't have access to get it out to do anything with. So there's a fine line. What most people want dentists to do, because you've studied hard, you're working hard, you're going to make a lot of money, is they want you to put as much money away as you can. Our belief is not that. We think it needs to be basically kind of averaged out to make sure that we've got a great plan to get you out of debt as quickly as you possibly can without tying money up that you can't get to. Yeah, some of our dentists have variable rate loans. So the last thing we want you to do is all of a sudden rates go up and instead of paying 5 or 6%, you're paying 9 or 10% and you don't have access to money. So it's a matter of having a plan. That's why we try to do these 30-minute free sessions to make sure we can help you kind of analyze what's going on. I think we got time for maybe one more, Steve.
Okay, one more. Let's see. How to use other people's money. How to use OPM is what they say. Other people's money.
Yeah. Well, and that's a great question. It's probably one of the primary reasons people have become very, very wealthy, other than people that started companies and their stock ballooned and they made all kinds of money. But using other people's money is the developer's way. Real estate developers do it all the time because they know they can drive all kinds of profits. You know, I've seen developers be willing to pay 18 or 19 or 20% to use other people's money because they know they're going to make 70, 80, 90% on the deal. Well, not many of us have that access to be able to do that. So other people's money for the typical dentist out there would be using the equipment companies, a Patterson or a Shine's money to buy the equipment. Well, that's good leverage, and like I said earlier this evening, because those pieces of equipment are going to make you some money. Our belief, the best OPM or other people's money is to use the insurance company's money inside your cash value, because in essence, since we are borrowing against the cash value and your money never leaves the policy, who is giving you the money? The insurance company. So it's a classic OPM of we're using the insurance company's money while they're still paying us interest on our money to leverage it to buy the pieces of equipment, to buy the real estate, to do all the things that we want to do, and we can produce very, very significant profits in doing that. And that's one of the things we teach you, probably not in our 30-minute message, but as we look at your situation to teach you how that can come into play for you. Well, Steve, I think that's all the time we have for tonight. Hey, Steve, it's always good talking with you. Thanks to all you on the call tonight. There are a lot of you around the country. We'll have this posted out, and everybody will get emails, and it'll be out on our website. So you can listen to my raspy voice again and look back at it. And again, if you have any questions, want to get together with us, don't hesitate to call or shoot us an email. And we'll have another one of our live webinars this next month in March on another topic that hopefully can help kind of pull the pieces together and everything for you. So thanks again for your time tonight. And Steve, it was good talking with you, and we'll talk again soon to everybody.
All right. Take care. Have a great evening. Bye-bye.
Yeah. Bye.